Greetings, Dr. Jeffrey Scott, and this is my weekend market update. Yes, I realize I'll be posting this on the 14th, but I always put the date of Sunday, which was the 15th, when I post them or create them. My email address is hgsidoc@gmail.com. If you're new to my channel, help me get to 1,000 by hitting the subscribe button and hit the alarm. There's no cost. The alarm just means you get notified when I place one of these up on YouTube. If you have constructive comments, positive or negative, I really appreciate them. Either email me and I will respond, or just put them in the remarks section on YouTube. Last weekend, we obviously had some major news events with what's happening in the Middle East. Um, we'll look at how that impacted the markets. A week ago Friday, we had a follow-through day, which, as somebody pointed out during my Wealth 365 speech, that they don't always work. Absolutely, nothing always works, which is why I talked about, adding to the longs but still maintaining cash and waiting for further confirmation. And this weekend, the comment is that new uptrend's under pressure, and I think it's from macro events. And oh, by the way, we're about to enter earnings seasons, which has its own level of volatility to this market. Disclaimer, as always, this should be considered education only. Anything I talk about, any stock should be considered in the spirit of education, not investment advice. I am a doctor, not a broker. I am independent. I am not on anybody's payroll from a stock trading perspective. Nobody pays me to say good things or bad things about their tools. And I've actually paid for everything that I use. Trading involves risk. You are solely responsible for any investment decisions you make. If you like these videos and you want more of them, I try and post frequently at stocksanddocs.com. I travel a lot with my day job, which is sort of the center of my trading style, which is I trade stocks. I typically identify them after hours or on the weekend. I put in conditional orders. I put in stops and targets when I put those orders in. I can use my phone during the day, and I do a lot of trading in Thinkorswim and Tasty, so their apps are great, so I can adjust as needed. But most of my analysis is using daily and weekly charts, and frankly, at end of day. And that's reflected in these presentations. Major markets tell the story. I always look at what happened on Friday, and the yellow are the major markets. Friday, you could see the NASDAQ led to the downside, down 1.3, and the Russell was down another 0.8. On the week, it was mostly green on the markets, but less than 1% up, except for the NASDAQ overall was down 0.2. The Qs, the largest 100, which have the gang of seven that have been leading this market, were actually up 0.2. But the big loser on the week is the Russell, down 1.6. So as bad as Friday may have felt, and I thought Friday wasn't as bad a day as I thought it would be when I looked at the indices, especially the NASDAQ. The week was relatively quiet considering all the things going on in the world, except for maybe that Russell. If we look at my Q Edge setup here, you could see that on Friday, 2/3 of the sectors were down. Now this is the S&P 1500. On the week, I think it was 8 and 3 on the S&P 500, but at least on Friday, most of the sectors were down. Healthcare, energy, and staples, kind of defensive looking, were up. 2/3 of the industry groups were down, and 2/3 of the stocks were down. So indices were kind of flat, but there were more down stocks versus up stocks. This tool is really cool because it is an intraday tool. Bad news is it probably requires you to have another data feed to do that, which is Metastock. But the ability to look at the larger market, sometimes you see the indices aren't telling the whole story. And often at market turns, you'll see that the market itself looks different than the indices. And that's something that I see often at a reversal. My bucket analysis to the right here, which could be done in EdgeRater, Q, and other tools, that just tells me that on Friday, more stocks ended up below the Bollinger Bands, kind of doubled, which just tells you Friday was a weak day. But even though most of the stocks are red, meaning below the midline of their Bollinger Bands, which 62% on Thursday went to 69 on Friday, and that's weak, only 10% are below the bands. And I'd like to see it to be 30% if I'm going to say we're getting close to what would be an oversold reversal. When you look at a month out, take these pie charts here, everything was down on the sectors. This is S&P 1500, 86% of the industries and 76% of the stocks. So August was supposed to be weak, and it was weak. September, we have just gotten through. In September, at best it was, well, it was weak. There were certainly some areas of opportunity, but when you look at it here for the last month, now you look at Friday, and again, it wasn't a super strong day, but it wasn't super weak either. When you look at this, this is actually as good as it's been looking back at 5 days, which was about the same, 10 days, which is inferior to Friday, and certainly the month was weaker. So again, don't let the indices convince you. I think there was more to this market than just the major indices. I'm not saying I'm a bull here or a bear here. But I'm just saying that maybe it was less weak than it felt on Friday. Another thing that I think adds to that, and again, I have a lot of tools, and I like to tell a story in these PowerPoints, so I'm going to use my different tools. But when I actually get down to finding stocks and searching what I'm going to do, I'm going to spend most of my time in wealth charts, which is not different than I do every day on my own when I'm not recording. So this is a market breadth total view. I don't have the ability to do this in wealth charts. It's a lot of different breadth parameters on one chart. So let's just look at what do I see. Total view means it's including the Dow, the spiders, the Russell, the NASDAQ. So it's giving you a very big picture of U.S. markets. I'm going to load this blue line here. This blue line here is the 13-week high-low line that I talk about, and I'll talk about in a few minutes. This is on a broad market, and you could see we went from oversold, and this would have been about a week ago, to not so much oversold right now. So there is no signal here that says, hey, this market's going to reverse. You could see this skull and crossbones here, which was a Hindenburg that was confirmed over here, and then we had more Hindenburg signals. Now, that is not a bullish sign for the market, but just because you have a Hindenburg omen doesn't mean you have a crash here, because most of them are going to be small pullbacks. Well, we got the small pullback, okay? So that's interesting to me. You look here in magenta, growth has been exceeding value, and down here, small caps have been underperforming large caps, okay? You see here listed 6 different indices. These red dots represent accumulation in green and distribution in those industries. And you could see that on Thursday we had one distribution. Now, if this market, and none on Friday, if this market was in the process of a major sell-off, I'd expect to see more of those distribution dots. Here I can look at stocks above the 200 in white, stocks above the 50, above the 50 in yellow, and then stocks when the 50 is above the 200 is orange, and you can see all of them showed some weakness. Sorry for that interruption. Miss Molly, my newly 2-year-old granddaughter, just popped in to sit on my lap, which is one of the joys of age, grandkids. So what do I see from here? Not a lot. I see the market's clearly in a downtrend going back to that initial Hindi over here. I don't see a market that's collapsed. I don't see a market that's given me a major overbought or oversold signal. And I see a market that says be cautious, but you've got support underneath. You've got a little bit of resistance above. We're in a trading range until proven otherwise. Next slide. This is a tool from Nick Drendel, and for a $45 give or take tool, it's a great tool. And I have this on a monitor all day because I see so much. I see major markets change at the moment. I love this side here. Where are they within the range? When you see a red day but you closed at the high of the range, it's actually not necessarily a horrible day. Here we closed in the bottom 20% for the most part, bottom 30%. It was a weak day. Here it tells me that all the moving averages that I look at are below the 50-day moving average. Okay, that tells me something. Over here, it gives me an idea of slope, and it's not all red. That's good to see. And actually, the diamonds were up some, as we talked about earlier, or showed you earlier. Industry performance on one day, I think this was a risk story. Gold miners up big, energy, oil, gas, biotech, which has been really in a tough period this month, down 14% on 50 days. Those were the leaders. And if you look at 5 days, those were the leaders over the 5 day period. And then with the conflict in the Middle East, really turned on defense. And you could see what happens to travel and entertainment when we have potential for escalation of conflict in the Middle East. Rates came down. Now, is this CPI, PPI? Was it the Fed minutes? Is you know, or is it the fact that they're concerned about what's going on across the world, and it's just a sign of that that's going to impact on growth? I think it could be all the above. We certainly were due for a pullback. We look how extended we have become. The left being the 10-year, the right the 30. I keep this in because it forces me to look at it every week. On the top is the yield curve of the 10 minus 3. On the right here is the 10 minus 2. The black line is the inversion line. The gray bar here represents a recession, and you can see pretty much when you invert, you get a recession. The recession occurs not during the inversion for the most part, but it occurs as the inversion is improving. What makes the inversion improve? The Fed cutting short-term rates. When would the Fed cut short-term rates? When they think the economy is in trouble. So they all go hand in hand. Yes, we've got an improvement, but we're still well below the zero on both the 10.3, the 10.2. If you ask me, do we have a recession in the near future? I say yes, but it depends what you consider near. We will always have another recession. That's guaranteed. Do we get one in the fourth year of a presidential cycle in front of an election? I think there'll be a lot of pressure to push it at least another 12 months. But I think those would say that, yes, you've got a recession coming. What signals am I going to look for? I'm going to look for increased on the high yield option adjusted spread on credit. When it rises, it tells me credit's become tight. It's off the lows for sure, but it's not spiking here. And then this Fred diffusion index tells me that we actually have decent economic activity, that you don't expect to see that in a recession. Breadth, stocks above the 200 drifted lower, stocks above the 40 higher. The 2121 actually on the week turned down. So I called it mixed. We're not at a level where you expect a reversal. That's really what I use breadth for. I look for breadth at overbought, oversold extremes that give me an edge. There's no edge here. Buckets, similar to what we looked at in the Q edge. And you could see small differences based upon how updated the S&P 1500 list is. And you could see the majority of the stocks in the red, meaning below the midline of their Bollinger Bands, but not a big peak underneath. No, there's no new Hindenburgs. We do go back to September. We had multiple on the NYSE, and that probably is meaningful to me. But notice green here represents new 52-week highs. Red represents new 52-week lows. And whether I look at the NASDAQ or the NYSE, although the NASDAQ is clearly worse, there is hardly any new highs ever popping up above 2%. Now, I've said a lot of things that said the market must have been horrible this past week, but it was mixed at worst. Here is one of my favorite reports in EdgeRater, where I look at ERG, which is a combination of scores 0 to 99 of EPS rank plus relative strength rank plus group rank. So the higher ERG are growth stocks. The lower ERG are what I usually consider garbage stocks. When I see the curve move from the lower left to the upper right, that tells me growth was in favor. Now, the number of stocks in each bucket or each line here is this gray line. And you can see there's really very few stocks below here and frankly above here. So I think if you chop off the head and the tail, you still have that direction. But for the most part, it's tracking below 0%. Here you can look at performance by EPS rank and relative strength rank, and it really doesn't favor anything. But perhaps the more optimistic was when I looked at the group performance analysis, taking a lot of different groups that I build and look at each Friday night, and then I watch what happens during the subsequent week. And so this ran from the 6th to the 13th. There's a lot of black, meaning a lot of positive groups. And the worst group, the worst three groups were trilogy cells. You want these to go down. This is a John Person, one of my favorite John Person signals, and they were down 6.79. So if you get a list of stocks that are supposed to do badly, that's actually positive. So these were supposed to go down. Stocks and groups moving to the downside was down 2.63, and stocks with supply short-term negative earnings group, one of Ron Brown's groups, was negative. But that means these were performing the right way. That's a good thing. But you look at what was leading bottom fishing for nuggets, Bible gap ups, leaders, best criteria, small floats with good criteria, were all leaders. So it's hard for me to say it was a horrible week. It was kind of a flat week for me. In fact, somewhere down here are my holdings that I entered the week at. And I remember I looked at them and said that was boring. Up 0.4% and kind of 6 up, 7 down. My buy watch, where I looked at new buys, was a little bit more favorable, but was only up 0.63. So to me, it was a flat week, and it just felt bad on Friday. And we'll look at the picture of the week in a few minutes. Know your news and earnings. On the left are Fed heads. This is the week that the Fed presidents come out to talk. So it will be very interesting to hear what they have to say. Will they talk down the increase at the November meeting? Or are they going to make us more concerned? Has the financial markets, with the increase in the rates over the last several weeks, already done the work for them? Can they start to talk about how they might be backing down and stopping? So this could be bullish or bearish. It's not going to necessarily be bearish. We even have Fed Powell down here speaking at 12 o'clock on Thursday. There's also economic news, Empire Manufacturing, retail sales, industrial production, home builder confidence, starts, permits, Beige Book, jobless claims. So pretty big week of earnings. And it's also the beginning of a 3 or 4 week period I often refer to as earnings Lalapalooza. Lalapalooza being the big music festival that my son likes to go to. And you could see we start in earnest, and we got big banks with Bank of America, Goldman Sachs, we got J&J, we got airlines, we got technology, we got Netflix and Tesla. We got a busy week. So I think this side may move the market as much as to the left. The other thing is with the 7 big cap growth tech stocks, of which 2 of them are reporting this week, at least. I didn't go through every list there. They represent 30% of the S&P 500. If any of these stocks, these big cap techs, blow up, it's not going to be good for the indexes no matter what happens. So I think it'll be an interesting earnings season. So reaction lower to Mideast news on Monday, headed higher by lunchtime, remained higher until about 12:50 on Thursday, and then sold off into Friday. Most of the indices were flat to slightly higher, except the Russell, which was down 1.6. Already talked about macro events, but the rise in oil price, that CPI, PPI were not weak. They just, I guess, weren't strong enough to worry people. I think this Republican consensus on a House leader is going to drag on the markets. You can't do anything about the Mideast from a funding or messaging perspective without Congress functioning. and without a speaker, you don't function. And then you've got a Fed shutdown in November, which will start to be a big issue if you don't fix the house. So we got earnings. Friday was a tough day for the bulls. We'll talk a little bit about what I'm seeing. And I'm not sure the new trend is over, but I looked at about 1,000 charts last night, and there were a lot more attractive stocks a week ago. Know your earning dates. I think it's still a good time to be selective, and I will be looking both long and short, but I'm not going big. I'm keeping my stops tight, and I'm keeping cash on the sidelines. It's hard for me to go all in the setting of earnings either way because they can move the market. Um, but I'll be watching just like you will. So let's go and take a look at, let's see, let me stop the slide share. Do that. Perfect. And let's take a look at the markets. So now for the most part, I'm going to be in wealth charts. Um, I think when you look at all the platforms out there, wealth charts has the most bang for the buck. My indicators, some are built in and included in their premium or premier indicators that come with the program. I do have a package that I sell for it for all full disclosure. But to be clear, I have packages for TradeStation and TradingView as well. And I think this platform itself is the best platform out there, and there's no harder working, smarter person. Well, John Person's pretty smart too, but Rob Hoffman is so impressive, his level of energy and what he does to support the program and its users. So here was the gap down, modest gap down on Friday. I'm looking at the 5 minute from Friday to Monday on the spiders. And then, we chopped around, and then late morning around 11 o'clock, we ran up to set the highs. And this is now we're looking at 10:10. So this would be Tuesday. Here was the peak in the market, sort of a double top on Thursday around 1 o'clock. And then the market eased into the end of the week. My guess is the escalation in the Middle East and the continued entropy in the house is what drove that down, but that's just my hypothesis. It ran up after the PPI. Maybe people realized that the PPI and CPI weren't as supportive of the market taking off. But whatever, if you look at a daily chart, you see on the week we ran up. This being Monday, Tuesday, Wednesday, we had a bit of a bottoming tail. And Thursday, despite a gap up, we pulled down, and Friday we closed. But on the week, we're still up because this again being um, the open candle on Monday. So are we in a range between the 420 and the 440 area, which is where the 50 is? I think so. Maybe the range is down here closer to the 430, 435. But right now we're range bound on the spiders. I think we could break out and go to higher highs. We could break down. Fortunately, we got a 200 here, the 420 level, and then at 414 we got the anchored VWAP to the 2022 high. So you got a lot of support underneath. So do I expect fireworks this week on the spiders? No. It's a pretty good size trading range. And for now, that 50 and that 420 to me is kind of what we're bouncing between. And I probably won't make a major decision directionally until we break above or below those levels. The Qs on the daily, you could see pull back into the 50, close just below the 50, up on the week. In fact, I can look at the weekly bar and you could see, well, up nominally on the Qs on a weekly basis. And remember, the NASDAQ itself was down a little bit, so the larger caps drove it. But you could see the topping tail right there. So the Qs broke below the 50, which I don't like to see. The diamonds on the daily, where these are, here you're between support and resistance. Here you're breaking through support. You're well below that 50 on the diamonds. Been bouncing off of this anchored VWAP. Actually teased above the 200. And right now it's got to break above the 200 before I worry about where we're going on the diamonds. And similar to the diamonds, the Russell breaking, bouncing around the January lows. And unlike the others, the Russell has broken down below the January lows. And this is a bit concerning, and I'm going to show you what I'm concerned about. I actually saw somebody come out and talk about October lows. Um, this is October. That's a June. I gotta go back even further. Nope, here it is. Here's the October 13 lows, which is this white candle. Excuse me, this white line. We're about 5% above those lows on the Russell. If we look at the other indices, in fact, I can just show you right here. God forbid the other indices, well, if you're long, God forbid. If you're not long and you're short, you're probably going to love it. But look at how far we are off these October 13th lows on the other indices. So the Russell, yeah, you're a couple bad days away from it. But boy, the rest of them, a revisit to those lows would be, to say painful, would be an understatement. So it's hard to get excited right now by the indices, except I don't think we've broken down and we're in trouble except in the Russell, and the Russell has been, frankly, this is an area of congestion that it's had in multiple times, so I'm not even going to get that alarm there. You'd expect to see volatility, and if you look at on Friday, the VIX had a big move, was up 16%. If we look at the week, the candle is not an ugly candle, but it still was up 10%. I mean, by not an ugly candle is it's well off the highs, and it's red, which means it's actually down from the open on the week, but it was still up a lot. The dollar, this is bothersome. You're now bouncing around at a recent high. This white double line here, which is really a rectangle, looks at the highs going back to 2023. We are now in a level that was last seen in November of 2022, which is about the time the market turned around. So it'll be interesting to see what happens here. Friday's candle, is it that exciting? It was up 0.07%, topping tail. Maybe it'll turn out to be a high, but you're off the recent highs here, but you're really in the same range. So I think this remains a challenge, and congestion and chop sideways move of the dollar at recent highs is not something I want to see supportive or expect to be supportive as the market. So with the dollar holding up, I was a little bit surprised about gold and silver, but I do think this has to do with the East and the concern, flight to safety. What happens if there's escalation, if Iran saber rattles, Saudi stop talking about normalization relationships with Israel? Um, Sometimes you forget what caused the conflict and look at where it's going. And right now, I think people are looking to see if Israel shows any restraint. Not that they should, perhaps, but I'm not going to get political and talk about it. That was just horrible what happened. It's horrible what's happening now, which I think is, to me, the safest thing to say. So gold and silver have both higher, oil higher, and when you look back at past crises where you saw the price of oil um, go up in these conflicts, it could go a lot way higher. Natural gas ran up, struggling at the 200, was down a bit on Friday. And then rates are well off their highs, which is really good to see. But look at this rectangle. It's got you all the way back to again, those October highs on the 10-year. And then you don't see anything to the left. Well, you don't see anything to the left because, let's make sure that's highlighted. Let's go look at weekly, because there is nothing at this level to the left. You've got to go back really far to get to this level. Oh, let me just extend the triangle. Bear with me. All right, you're going all the way back. Of course, the triangle's probably moved a little bit when I've done this, so I'll fix that later. How far am I going to go back? I'm going to go back all the way to 2007, 2008. So these are pretty, well, they're significant rates. You're living in the same world I am. But these rates are high. And think about how big the Fed deficit is and when payments are going to get tied to these rates. Can you imagine what that's going to do to the deficit? Wow. Weekly market timing. I apologize for the editorializing. I'm trying to stay out of making any comments about the Middle East because I don't think that's the vehicle that I want this to be. I have strong feelings, and so I'm going to sound wishy-washy just intentionally. On the weekly market timing signals, you'll see that we have maintained the sell signal on the spider. We're below the moving average. The bongo is red. That 420, I think, is going to be the magnet. The Russell, clearly in a sell signal below the moving average. Weekly bongos red. The diamonds have broken down below the moving average. Bongos red. The only thing that's holding on is the Qs, who were a little bit higher this weekly, 0.16. But with a big red on the bongo, all I can do is give it a yield sign. Careful time. That's what this tells me. Kind of consistent with what I've been saying to you. Now, one of the things that I love about wealth charts is how easy it is to do ratio charts. And I've talked about this many times before, but I think it's important to keep looking at it. This is a curve looking at TLT versus the spiders. This is what happened in 2020. If we keep going backwards, this is what happened in 2016. I keep going backwards. Let's get to 2008. Here's 2010. Here's 2009. The message that I want you to take home from that little journey is that if we are going into a recession, because those were some of the recessions we've had, expect that to spike. It has not spiked. That's the big message there. Um, and then here just showing you that the Q's way outperforming the Russells, but you already know that. On the hourly sector scanner, where is there strength in this market? And I haven't moved my stars yet, so let's see if I'm going to give anybody a star. I'm going to take away my star because communications have come off the high. And FANGs, this is interesting. This is actually late breaking news. It probably is related to what caused Friday weakness as the FANGs underperformed versus the spiders. So what am I looking at? I'm looking at two things here. I'm looking for what's pointing up to this upper right-hand corner on each of the boxes. The one that's pointing up to that upper right-hand corner is the one that's been leading. The one that is green or red at their last bar, especially if like on healthcare or staples, utilities, it's a pretty significantly sized. That's who's moving now. So what I really see here is I see that the defensive things have started to move. Staples, real estate, utilities, and healthcare. That we're not done, but communications technology have come off their recent highs. Discretionary, which was leading for a long time, is in trouble. Do I see anything here that says, here's the strength, this is where I want to go? Because frankly, that's what I'd like to tell you. No, I don't. You're going to see that energy, gold, silver are kind of the places that look okay. And you can see energy had that blue bar for most of the session on Friday and this week. It is closest to the highs. That's probably the one that looked the best on charts. But I think we're rotating maybe out of that technology and FANGs, at least we were on Friday, into more defensive plays. Stock scanners, a lot of things I look at here. Let's start with the heat map. Let's look at the S&P 500. It's one of my favorite things to look at every night to ground me and give me a sense of what the market did. I think you can get grounded pretty easy on this chart. And what I see is a pretty weak market overall with some pockets of strength in energy, in healthcare. PXD was a takeout. JP Morgan was up on earnings. Dollar General was up on a new CEO. But overall, the larger cap names are all negative. That probably tells me something. Then I like to go to Wealth Scanner and look to see if I can find anything that's showing strength using their algorithmic wealth score. And I'm looking at top-down indices, and boy, we have something new has entered the building. I don't know much about RWM as a trading instrument, because I typically trade the TZA if I'm going to go short. But the weakest index I showed you by looking at charts was the Russell. And here's a short the Russell that if this was a common stock, I'd be saying it's one of the better stock charts that I see here. Obviously, it has had choppiness, but boy, you're in an area of taking out recent highs. Your relative strength and OBV are strong. You had a recent pullback, and now you're moving. RWM, that's going to tell me we need to look at contra ETFs today. SARK is a short against the TZA, against, excuse me, ARKK. And this one just broke out above the 200. It's above the 17 and the 50. Look at relative strength, OBV. When the first two things I show you are shorts, showing the strength, what does that tell you about the market? MLPs looked really good. This is an MLP ETF. The MLPs pay a dividend. I don't know this ETF, but I bet it has a dividend. But look at this. It just broke out above congestion, and we've now at a high going all the way back to November of 2022. Look at all the green dots that have come in the last several sessions. Wealth signals have fired. Relative strength at OBV looks great, and you're not oversold. Excuse me, overbought. So maybe you should look at MLPs. We'll look at some of them. The dollar maintains strength. Here's another MLP. That tells me something there. Here's short mid caps. Here's short small caps. Hey, here's short the world. I think we're getting a sense of where the strength in the market is. Is it time? Does this mean that the market's about to roll over hard? It's earnings seasons. A lot of things could happen. The war could stop. The war could get worse. There's got to be caution with just what I just showed you. Let's look at the bearish leaders and laggards on the top-down indices. So it's switching the analysis to look for the lowest scores. And then I'm going to switch it once it comes through, and I'm going to rank them from the lowest number. And while I'm waiting, let me just make my editorial comment. I really didn't want to talk politics. I am Jewish. I have my personal beliefs. I just don't think this is the forum to talk about them. I think that what's going on in the Middle East will impact the markets, so I can't not mention it. I think it's already impacting the markets. I think it will increase the price of oil. I hate what happened that started it. It's despicable. You don't go after civilians. But at the same time, I also recognize that there's pain on both sides. So I'm staying out of it, except it's a horrible time for the world. And I hope the conflict ends quickly. And again, I'm trying to be as non-political as I can. Where's the weakness? ARKK, no surprise with SARK being a leader. Semiconductors, internet, Russell, materials, new economies, mid caps, transports. It's the crazy thing, to be honest with you, is maybe I should be a lot more bearish than I feel. I'm not there yet. Maybe it's the seasonality. Maybe it's my belief that the Middle East will calm down and the markets will recover. Maybe I'm being lulled by that follow-through day we had last week, and I haven't had enough signals on a breath to say bail now. But I think the idea that caution matters here is pretty obvious to everybody. So I like to use my scanner to help me find where the opportunity is. So first I'm going to look at, since we saw MLPs, let's go into, I've got a group I built which is called Driller, Refiners, and Integrated. Why? Because these are the ones that seem to work together, not just the exploration and production. And we'll see what comes up to the top. AMPI. So this one, I don't like the fact that it's coming up to the 200 and once, twice, three times. Here it was support, and now it's resistance. I'd have to see a break above it. It did have a breakout momentum signal, so I would watch it. BP, this one I love, but I'm looking at the high jump tells me it's not overly extended compared to the past. It's just had a big run here, but believe me, if this conflict continues, most of the energy complex on the producers is going to go higher. Coal has been really strong. CNX is breaking out here. All right. ConocoPhillips is another one. Of course, I didn't bring all my threes up. Let's see. Why is that? Okay, now I got that. Okay. BP, CVE, I think is another integrated. The integrateds I like because they have exploration, they have transmission, they have refining, and they, they still probably move with the price of oil, but they also have natural gas, many of them. Gas has been stronger of late. Here's EOG. ESTE is a smaller producer that's breaking out here. Marathon Oil, a name that I've known from my youth, breaking out here with volume, relative strength and OBV. So there are things here. Matador is breaking out here. So there are plenty. I already mentioned CNX. I am, LNG is liquid gas, liquefied gas, big breakout here with the natural gas improvement. I think part of this is probably because Israel's a net exporter of natural gas, so that might impact that market. And then the one in coal, since I mentioned coal, that I've been playing and I think I've talked about it multiple times, I don't think, I know, has been Consolidated Energy. And you could see how this thing's just in a beautiful power run, running right up to 17. So I talk about 50-day moving average being free parking. Um, this really strong stocks will run up that 17 as you're seeing by CEIX. Now, I could look at the broader market, and I have a list of close to 1,000 stocks that to me are the leaders in the market right now. And if we look at some of them that come to the top, you can notice there's very few 4, 3s, 2s. This tells me the overall strength of the market is weak. And remember, there was no industry groups that were bullish that came up to the top either. Ehang is a Chinese play, don't know anything about it. Um, on one of my platforms, it had nothing for a couple of days, and I don't know if there was, maybe it's just one day. I don't know if there was news or if it was a China holiday. I don't like the close. I don't like to see something gap up like that and close near the open. But I do like the fact that it broke above the 50, had a wealth signal and an EMS signal, massive volume, breakout momentum. I'm not seeing news open up here. I'd make sure there wasn't a takeout offer or bid on it. Relative strength and OBV look great. It's on my watch list. I'm just going to have to do more research about it. Progressive, there's strength in insurers. That was one of the few. I think it was KIE was on my when I looked at the bullish wealth scanner. It's running now. I don't want to waste the time. KIE was up there. So here's a stock in a nice uptrend that had a breakout on massive volume. Breakout, a gap up volume, breakout momentum coming out of a squeeze. Relative strength and OBV look good. Yeah, short term it's a little bit extended, but I'm not sure I wouldn't be looking at Progressive. Allstate, I like this one as well. You look at the actual pattern of the chart, it's not that dissimilar. Took out the 200 on volume, breakout momentum, relative strength, and OBV. Since it's sitting on the 200, it's a lot less extended. Apellis is a pharma. I wonder if this is in the the NASH cirrhosis world. I can't remember what they do. I'd have to understand why they had this big gap down. It's below the 200. I don't usually chase these until I understand them. Cigna is a health insurer. Um, Health insurers have sold off, as you saw this, but they're rallying. This had a nice move. A wealth EMS came in a few days ago. A wealth signal, volume, breakout momentum, great relative strength in OBV. Um, in that same complex, you can look at United Health, whose earnings are out and who had a positive response to earnings. Now, all right, so the numbers aren't in here. They had good earnings, so obviously they didn't miss by 100%. So that it came out Friday, so we'll wait for that data. But a nice gap up and a move. This is a great company beyond just being an insurer. And the other one that looked, I think Humana looked interesting as well. So we do have Elevance earnings this week. Humana's is out here. Um, hasn't been reported yet. So be careful about earnings, but healthcare looks better, and so do insurers. And Molina would be in that category as well. A Medicaid insurer, and talk about a beautiful leader coming off of its lows back here in May. Um, volume breakup momentum coming out of a squeeze, relative strength in OBV. So, and then I'll finish with this one and then move on to the contras. DBC, I saw a number of different commodity ETFs. Obviously, gold is helping that. Maybe it's a flight to fear, and it's certainly oil's not hurting it. You can see an EMS signal right at the 17 and the 50. Breakout and momentum. Relative strength looks good. OBV, it's an ETF, probably means less to me. And then there was another one I just saw here. Where did it go? That was DBC. I think it was GSG. There's another commodities ETF. Also breaking out. The volume looks better. You don't want to see commodities leading if you're long the market. So, and then speaking of gold, most of the gold stocks have been really beaten up. Pretty sure this one must be one that was taken private and came back. Maybe I'm wrong. It just didn't seem, well, no, I guess it shows the data. Goldfields broke out above the 200. It's been in a, like all the gold, it's going to reflect the price of gold. But that one's got had a nice move, and it's at least it's above the 200. When you look gold in general, um, you could see it's running right up into a 200. Lastly, I want to talk about the contra ETFs because I think you've got to. I'm not saying you have to go short this market. I'm certainly not saying go all in this market. But I think we have to recognize that the market's different this week than it was on Friday last week, especially since what happened on Saturday in the Middle East and the market volatility that it throws in. So if I look at these purely as a pullbacks and uptrends with momentum coming in or a trading signal, the two that came up were the VIX. So this will go up with volatility. Not really a contra ETF, but it's a one to trade in markets that are falling. In some markets, when the market collapses, you see a spike in the VIX. I've never seen the VIX go to 164. The reason why I see that line so high in the VXX was probably not that it traded to 164, but it's like most of the country ETFs, there have been so many reverse splits that it gives you artifactuals when you look at those numbers. Yes, compared to today's dollars, if you'd bought it then, that's how much it's dropped, but I wouldn't expect it to run that high. That's why when you look at the scale, look at how big the scale is. It's because of reverse splits. So big volume on VXX, breakout momentum. Here's the reversal on the bongo. Relative strength and OBV look good. If this was a stock and not just a volatility ETF, I would say this looks great. It's got to get above the 200. But that's a 40% move to the 200. So I have no issue with looking at VXX. TZA, we've already talked about the other ETF for small caps. Doesn't this look like the stocks that I like? Pullback, breakout, momentum over the last 2 days, relative strength OBV look good. The fact that a contra ETF looks interesting to me from a pattern is a bad sign for the market. Now, if I want to look at the entire group of the contra ETFs, let's do that very quickly. We're at 48 minutes, and then I'm going to stop. And again, for those that I upset, I try to be as calm as I can on the conflict. And I'm saying this 5 times because it is an emotional thing, no matter what side you're on. And I feel bad for the innocent on both sides. It's just a horrible thing. Um, and I just don't want this to become a political statement because I could be, and that would not be fair to you. It's not what you're here for. Dog goes up when the Dow goes down. Um, isn't really giving me much of a signal here, but it's pulled back to the 200. Dust goes up when gold goes down. Well, gold's going up, so dust is going down. SARC goes up when ARKK goes down. This is giving me a beautiful breakout here above the 200. Obviously, tons of overhead supply. And if this market goes up, this will come down, but that's one to look at. SDS will go up when the S&P 500 goes down. It's pulled into the 50. And just like the S&P 500, there's a trading range here that it might just go sideways in for a while, but at least you'd be buying it off of support. Not advocating buying any of these. I'm just making sure you're aware of them. SOXS is one that would go up if semiconductors go down. Obviously, semiconductors had been very strong before they sold off. S&P XS is another one of the ETFs for the spiders. SQQQ is an ETF that will go up if the Qs go down. Um, you're not seeing much of anything happening here. The Qs, although they were weak on Friday, were the best on the week, sideways at best. TZA is the one we talked about, and then the VXX. So let's just summarize and try and put my mind together on what I'm seeing in this market. The first thing is the market is not easy right now, and therefore I've got cash on the side. I did open a couple of small positions with a follow-through day a week ago, and frankly, I haven't even been stopped out on them. So there's still some strength in this market. I have less positions now than I did a month ago or 2 months ago in August, going into August. I've got less positions than I normally have, and I've got more cash just because it's cautious. There are a lot of factors out there, positive and negative, that will impact on this market. If, on the bullish case, if the Fed comes out and says, we're done, the market may sell off for a little bit, but then it's going to go higher. If tomorrow there's a truce in the Middle East, oil will come down, gold will come down, and the markets will probably go higher. If we have great earnings this week and the big leaders say things look great going forward, market will probably go higher. On the other side, think of the risk we have. No settlement in the Middle East, oil goes higher, gold goes higher, stocks go lower. Escalation could be dramatically different to the downside. If we can't get somebody in Congress as speaker, as we get closer to the November period of time that the budget becomes an issue, the markets probably won't like that. There's so much going on. You got to be careful in this market. Don't forget about earnings. Did not say at any time you can't play this market. You can. Just be careful. And I'm going to be looking for longs and shorts, and I found a bunch. And I'm going to be looking at small positions with tight stops because this is not an all-in to the long side or downside. So again, it's an emotional time out there. I have family in Israel, so I've tempered my comments because, as I said before, that's not why people come here. I hope the innocents are safe. And on that note, I wish you a great week. I'll be traveling to New York this week. I'll probably get a couple of the stocks and docs ones done because it's going to be a volatile week. Prayers for the families, especially of the hostages, and we'll see you next week.